Welcome to this week's live ASX strategy session. Thanks for joining me. Great having you with me for another show and heaps of stuff to talk about. We've got a pullback in the local market, new all-time highs in the US. Gold continues to pull back. Uranium starting to rally again. So lots of interesting things to go through. And of course, we'll go through your stock codes in the second half of the show. So any stocks you're interested in having a look at, we'll get those ticker codes ready. We'll go through those a little bit later. As always, everything today, general commentary only, doesn't take your personal situation into account. Having been through all of that, let's get straight into this week's first chart. And as always, starting off with the ASX 200. And so the ASX 200, it has quickly given back most of its gains from mid-October. Is this a start, or is this a sign of more weakness to come? I'll talk a bit more about this latest development in a moment. And then over in the US, the S&P 500 has just done something it's never done before. I'll explain what that is shortly. But before we get to that, let's start with this latest price action in the ASX 200. So some volatility. Some volatility has entered the picture this week. The last couple of weeks prior to this week's down day, the last couple of weeks had been fairly quiet. The ASX 200 had been doing a good job at holding onto its gains following this rally off the 50-day moving average in mid-October. And up until this week, we'd had a shallow sideways consolidation. And as we often discuss, shallow consolidations are, well, they're usually a good sign that the dip is being bought. But of course, that changed on Wednesday when we got this quick sell-off after the inflation numbers. Now, the question is, does this impact this overall trend that's been in place for many months? And should we be looking at Wednesday's weakness as maybe the start of something bigger? And I think the short answer to both of those questions, I think it's no. So far, all we have is a pullback to the 50-day moving average. Now, as usual, I've got the 50-day and the 100-day moving averages on this chart. And really, what we have so far, it doesn't alter the overall trend, which at this point, it remains up. We still have rising moving averages. You can see both the moving averages continue to trend higher, and price is generally above those moving averages, albeit only just on the 50-day. But price is generally above the moving averages, so that remains a bullish backdrop. I think what the pullback does signal, what this pullback on Wednesday does signal is that we're likely to see more consolidation in the near term. And then the question I ask then is, like, what's being consolidated? It's like, is the consolidation is it a consolidation of this rally off the September low? So see the low in September, prices have had a good rally over a month or so. Is it a continued consolidation of that? So for instance, could it be a case that we get narrow sideways price action within a range for several weeks, and then from there that generates the platform, which could then lead to a breakout and higher levels, like that consolidation along the moving averages. That's one possibility if it's this consolidations following the rally of that September low. Another possibility, whether it's a case of like, is the consolidation a continuation of the consolidation since the April high? And if that were the case, maybe we could see a retest of the 100-day moving average and maybe a retest of the September low. For instance, it could be a case that there is that more. Let me just get that marker going again. It could be a case that prices do have some further downside, but then stabilise within a larger range before possibly making their way higher towards maybe the back end of November, maybe into December, and we just get that larger sideways range. So I think both of those scenarios they're equally as valid, and of course something completely different could happen as well. But I think the key point is I don't think we need to predict exactly what's going to happen next. I think the key point is that at this point, at least, it looks like a corrective move within an ongoing bullish market, not the start, one down day, not the start of a bearish move. I'll show you a few things I'm watching that I think supports this view. So, firstly, let's jump over to the materials index, so the ASX 200 materials, and this is a bullish chart structure. We have a strong rally out of a 3-year trading range. Let me just compress this a bit. You can see the material. So this goes back, this point here, that's 2021. We've got this big 3-year trading range. We could say the range maybe started in 2022. Any which way you want to look at it, it's a large sideways period, and now we have a strong rally out of it. So what we often find when we get breaks from big ranges, we often get big trends. So I think this has the potential of being the start of a notable trend in the materials index, which of course includes the mining stocks. But of course, it doesn't all happen in a few days. Rallies are followed by consolidations, and that's what I think we're seeing now. Materials put on a quick 15% from the mid-September low. So you can see prices came back to the 50-day moving average. There's a quick 15% rally in the space of about a month, and now we're getting the consolidation of that move. So nothing really surprising there that you get those pauses after a big move. Proportionally, I think this probably needs several more weeks of backing and filling, like just looking at the extent of the move and also what came before that. I think several weeks of backing and filling where we get that sideways price action, possibly even like the zigzag consolidation where it comes even lower. Just either back to the 50-day moving average or gives the 50-day moving average time to catch up. And that also fits with maybe some more consolidation in the ASX 200. But I think I think the underlying message is that this remains a bullish structure. Coming over to the other big part of the local market, it's having a look what the financials are doing. And it looked like we had a bullish break earlier in the week. Prices have been trading sideways in this trading range since mid to late August. Looked like we had a break higher on Tuesday, but then that quickly failed. That break quickly failed on Wednesday. Prices are now back within the range. Sometimes a false break can be a bearish warning. When we talk about this, where you get a breakout, doesn't have to follow through buying, prices come back. That can be a bearish warning. But in this case, I think it's simply a matter of a market that's not ready to move higher, and hence it's pulled back towards the 50-day moving average. Prices they continue to cluster around the moving averages, so the 50 and the 100-day moving averages, and you can see that's been the case since late August. It seems to me that this is a sector that wants to move higher. That's what the buying pattern suggests. We've got this. You can look at the series of rising lows through here as well. That's been occurring consistently since July. So the pullbacks are being supported, the dips are being bought. We've got the rising lows. We've got the cluster around the moving averages. So as I say, I think this buying pattern suggests this is a market that wants to move higher, but maybe it's not quite just ready yet. I think we probably see financials consolidate further in the near term, but like materials, this remains a bullish structure. Rising moving averages, price above the averages, consolidating with dips being bought. That's not a bearish setup. Of course, anything can change, but at this point, it's a bullish structure. And I also wanted to just quickly show you the equal weight, the ASX 200 equal weight, as we're just going through these parts, these components of the market. And again, we've got a bullish picture. We've got the rising moving averages, prices above the the averages. In fact, the equal weight has been trending stronger. It's had stronger trending conditions than the ASX 200. If you remember what the ASX 200 looks like, quickly jumping across. We've really been going sideways for close to a couple of months. The equal weight, on the other hand, it's continued to push to the upside until most recently, where we've had the pullback, and this, I think this is really important, as it tells us that the rally, that the overall rally we've been seeing in stocks, it's not just a big cap rally. It's not just about CBA and a few of those large cap companies. It's broad based. It has to be broad based for the equal weight to be going up and for the equal weight to be outperforming. And it's, for me, it's often a sign of a healthy underlying market. The small ordinaries, the emerging companies also provide an important insight. I'll look at them in detail in the member section a little bit later. But for now, I think the equal weight, I think there's certainly scope for more consolidation in the near term. It's been a big advance, no matter where you measure it from, whether it be from September or from July or even back in April. It's a very big advance. It's only had these shallow pullbacks along the way, but I think what we can see so far, it looks like a corrective pause, not something more ominous. So for me, it's a case of staying with the trend, wide trailing stops to try and see off however long this consolidation may last. Okay, so we're going to jump to the US market now. After that, we've got the small caps, US small caps, Aussie small caps, gold, copper, oil, uranium, all of that coming up. US market now. But before we do that, if you're getting some value, please hit that like button and leave a comment. What do you think? Do you think, how long do you think this pullback's going to last? Is this like going to be a short-term thing and we're off? Or is something more bearish happening? What do you think's going on at the moment? But whilst you're thinking of it, especially now, click that like button. Really important. It helps me heaps because it tells YouTube that people are watching the video. Then YouTube shows people. Makes a big difference for me. So click that like button now whilst you're thinking of it. All right, over to the S&P 500. I saw an interesting statistic this week on the S&P 500. It's had more all-time highs in the last 13 years than in any other 13-year period in history. So it's pretty interesting. Like, there were really strong periods during the 90s, late 80s, barring the 87 crash, of course. There were strong periods in the 60s, but yet the last 13 years has seen more all-time highs than any other period. And it's also interesting when you think about some of the events that have happened in this 13-year period. So let's just get that 13 years on the screen. That's thereabouts. There's the 13 years in question with all these all-time highs. And think about some of the events. We've had multiple wars. Got, let's not forget COVID, which is almost looking like a blip on the chart now, but it was anything but a blip at the time. Inflation, interest rate hikes, economic slowdowns. There have been several trade wars. 4 corrections of more than 20%, plus a heap more that were over 10% but less than 20%. I think if you're following the headlines only during this period and not looking at the price action, if you just follow the headlines, you might have thought that was a good 13 years to just sit out. But if you're following the price action, and of course that's what we do here, we follow the price action, not the headlines, then you probably made some money. It's never easy. There's lots of difficult periods in between, but we've had these trending conditions as we get in over time in all types of markets. So what's the price action telling us now? Let's just come back to where things are. What's this latest price action telling us? Well, it's an interesting situation in the US. The S&P 500 just hit its 36th all-time high for the year. And in fact, there have been 4 all-time highs just in the last few days, so in quick succession. So if we just look at the S&P 500, all looks good. We've got the rising moving averages, the 50 and the 100-day averages. They continue to trend higher, of course. We've got all those all-time highs. in there. So those are all bullish markers. They're things that you hear about in a bullish trend. But I think there are a few signs, the S&P 500 and the Nasdaq, maybe they're getting a little bit ahead of themselves. So yes, it's a bullish trend, but it's really we've really got a situation where the big cap stocks are now diverging from the broader market. I'll show you what I mean. Let's have a look at the S&P. This is the S&P 500 index, the market capitalization based S&P, where Nvidia and Microsoft and all the big companies have the most influence. Let's jump over to the S&P 500 on an equal weighted basis, where the 500th company has as much influence as the biggest company. And different situation over here. So while the S&P 500 has been making new all-time highs, the equal weight has been pulling back. It's now just below the 50-day moving average. The overall trend is still up. So don't get me wrong there. The overall trend here is still up, but there's just no momentum to the trend at the moment. And you just look at the price action, and the equal weight, it continues to consolidate in this range, which it has been doing so for the last 2 months. With prices closing near their low, like you look at the close on Thursday, prices opened, they rallied, and they came back and closed at the low. I think that suggests the equal weight's probably going to retest the 100-day moving average, and then maybe the October low as well. Maybe next week, maybe we could see this come back and retest those levels. And it's not just the middle and lower tier S&P 500 stocks that are pulling back. This is happening across the market broadly. Let's jump to an indicator. We look at this indicator sometimes. This is going to show the percentage of Russell 3000 stocks. So don't confuse this with the Russell 2000, which is small caps. The Russell 3000 encompasses much of the US market. So this is showing the percentage Russell 3000 stocks above their 100-day moving average. And look how this indicator is tracking at the moment. What it's showing now is that only 46% of stocks are above their 100-day moving average. So in other words, more than half the market is below that key 100-day moving average. You'll also notice that this number has been declining particularly in the last week, but also we talked about this 4 weeks ago and noted that it started to drift below its own moving averages. But it has been declining in the last week. And what we talked about a few weeks back was once this indicator dips below its moving averages, it tends to persist for a while. And I think that's what we're seeing now with prices, the indicator bouncing back, getting to the averages, and then starting to come off again. And let me just compress this a bit. And you can see how this works in the past. Once it's below the moving averages, that weakness tends to persist for a while. And just looking at the indicator's structure at the moment, the way that's been declining, I think it's setting up to go below its recent low from early to mid October. If that were to happen, then there's less than 44% of stocks above their 100-day moving averages. And I think with so few stocks then potentially participating in a rally, I think the upside could be limited in the near term. In fact, I think the odds are now starting to swing towards that consolidation, which I was discussing with the equal weight in particular. Just a note on this indicator. You can see it's quite cyclical in the way it goes from highs down to lows. But just because it's coming back, it doesn't mean that it's got to make its way all the way down to the bottom before it turns higher. During bullish phases, you'll note that it pulls back, might get a bit below 50%, then stabilize, and then move higher again. I think we could see something similar happen this time around. But in the near term, I think there's some lower levels. I think there's some more consolidation. until we start seeing an improvement in the participation, I think that maybe maybe treat the recent all-time highs just with a little bit of caution, just in the coming weeks. Coming back to the S&P 500 briefly, just to be clear, I'm not calling a top. I'm not suggesting a big reversal. I'm doing nothing of the sort. The overall trend is up. But I think that anyone who does try picking tops and big reversals, and you see it all the time in the news feed, someone's calling something dire to happen. I think people who do that within an uptrend, I think they're playing a low odds game because the trend tends to persist for longer than people expect. But I do think that the price action in the equal weight and in that indicator I just showed you, I think there are reasons to maybe hold off new purchases just for the time being until this situation clears up a little bit, and possibly cut back a little bit on leverage. For anyone using or considering leverage, leverage can become a bit of a handful when markets pull back. I'm still long the S&P 500. I plan to stay that way until the structure gives me good reason to do otherwise. But the thing with markets is it's rarely one-way traffic, and we never want to become complacent. Keep an eye on other things that are happening, and manage risk. That's what it always comes down to. Okay, so we're going to move on to the small caps now. They've got the US small caps, the Aussie small caps, all the commodities, copper, gold, oil, uranium, very interesting things happening there. But of course, that wraps up the free section. If you're not a strategy session member, there's a link below. Click that, come in, get the rest of the show. Come and join us live next week. Ask about your own stocks. Lots of interesting things to go on, and it costs very little for the amount of value that I think you're going to get. So, okay, so let's jump over to let's start with the Russell. We'll go to the US small caps.